Investing explained simply. What is investing and how does it make you money? Imagine I give you £1,000. You have three choices. You could spend it, you could keep it somewhere safe, or you could try to make that £1,000 produce more money. And that third option is essentially what investing is all about. Investing is putting your money into something today because you believe it could become more valuable or produce an income in the future. But that raises a pretty obvious question. How exactly does money make money? Let's make investing really simple. Money that goes to work. Imagine your money as a person. If you keep £1,000 underneath your mattress, your £1,000 is basically asleep. It's still there, but it's not doing anything. Now, imagine instead that your £1,000 gets dressed, puts on a hard hat, and goes to work. Perhaps it helps a company build another factory. Perhaps it helps a government finance a project. Perhaps it buys part of a property. Perhaps it buys ownership in a successful business. Your money is now being used to try to create something, and hopefully, over time, you receive more money back than you originally put in. That is the basic idea behind investing. Of course, there's one enormous catch. Your money might go to work and get fired. Investments can increase in value, but they can also decrease in value. And sometimes you can lose a significant amount, or even all, of the money you invested. That's why investing is different from simply saving money. Saving and investing are not the same thing. Imagine two cars. The first car is parked in a secure car park. The second car is being used as a taxi. The parked car isn't earning very much, but it isn't traveling around the city taking many risks either. The taxi, on the other hand, is out working. It's picking up passengers, it's making money, but it's also exposed to traffic, breakdowns, and accidents. That's a useful way of thinking about saving versus investing. Saving is generally about protecting money that you might need. Investing is about accepting some uncertainty in an attempt to grow your money over time. Neither is automatically better. They simply have different purposes. If you need £5,000 next month to pay for something important, putting that money into an investment that could suddenly fall by 30% probably isn't particularly sensible. But if that £5,000 is money you don't expect to need for many years, you might decide that you're willing to accept some ups and downs in exchange for the possibility of greater long-term growth. And this brings us to one of the most important ideas in investing. Risk and reward are connected. If somebody tells you they have an investment offering enormous returns with absolutely no risk, be extremely careful. But what are you actually investing in? This is where investing can initially seem complicated. People start talking about stocks, shares, bonds, ETFs, funds, property, commodities, cryptocurrency, and dozens of other things. But don't worry, they're essentially just different types of assets. An asset is something that has value. Let's look at a few examples. If you buy shares in a company, you are buying a small piece of ownership in that company. If you buy a bond, you are essentially lending money to a government or organization under agreed terms. If you invest in property, you are buying an asset that might increase in value or generate rent. If you invest in a fund, your money may be spread across many different investments at the same time. You might even invest directly in a business. Imagine your friend wants to open a coffee shop. They need £100,000. You provide £10,000 in exchange for 10% of the business. You have just become an investor. You have exchanged money today for ownership in something that you hope will become more valuable tomorrow. So, how does an investment actually make you money? There are two very useful ways of thinking about this: growth and income. Imagine you buy something for £100. 5 years later, somebody is prepared to pay you £150 for it. Your investment has increased in value by £50. That's growth. But some investments can also produce money while you continue owning them. A property might generate rent. A bond might pay interest. Some companies distribute part of their profits to shareholders through dividends. That's income. Here's an even simpler analogy. Imagine you buy a small apple tree. The tree costs 100 pounds. Over the next 10 years, two interesting things might happen. First, the tree itself might grow. Someone who would have paid 100 pounds for it originally might eventually be willing to pay 300 pounds. That's growth. But every year, the tree also produces apples. You can sell those apples. That's income. The tree is your asset. The apples are the income produced by the asset, and a good investment can sometimes give you both. But why would the tree become more valuable? This is possibly the most important question in this entire video, because investing isn't supposed to be, I bought something and I'm hoping somebody randomly pays me more for it later. There usually needs to be some reason why an asset might become more valuable. Let's imagine that instead of an apple tree, you own part of a company. We'll call it Joe's Pizza Company. Joe's Pizza starts with one restaurant. It makes 100,000 pounds in profit every year. Then customers start recommending it. The company opens another restaurant, then another. Its profits rise from 100,000 pounds to 500,000 pounds, then to 1 million pounds. The business has become larger and more profitable. If you owned 10% of that business, your 10% could now be considerably more valuable than when you originally bought it. That's the fundamental idea. You're not supposed to make money simply because a number magically moves upwards on a screen. You invested in an underlying asset, and something about that asset changed. This is something we're going to return to again and again in this series. Whenever we're looking at an investment, we'll ask, where is the return actually coming from? Because money doesn't magically appear. Why do investment prices move so much? Now things get slightly more interesting. Imagine Joe's Pizza is doing brilliantly. Everyone loves it. Investors think it's going to become the biggest pizza company in Britain. Lots of people want to own shares in it. Demand increases, the price rises, but then suddenly there's some bad news. Sales have fallen. The company has opened too many restaurants. Its costs are increasing. Now, investors aren't quite so optimistic. Some decide to sell. The share price falls. That's why investment markets move. People are constantly trying to answer the same question. What is this asset worth today, considering what I think might happen tomorrow? And different people arrive at different answers. One investor might look at Joe's Pizza and think, this company is going to be enormous. Another might look at exactly the same company and think, this is massively overpriced. One buys, the other sells. And that's one of the reasons markets exist. Investing is about the future. Here's something important to understand. When you invest, you don't know what's going to happen. Nobody does. You might study a company for 3 months. You might read every financial report. You might understand its customers, competitors, and management. And then something completely unexpected happens. A recession, a new competitor, a technological breakthrough, a scandal, a war, a change in government policy, or maybe customers simply stop wanting what the company sells. That's risk. The future is uncertain. And because the future is uncertain, investment returns are uncertain too. Why would anyone take that risk? Good question. One reason is that simply keeping money as cash creates another problem. Inflation. Imagine today you have 100 pounds. Let's say 100 pounds buys you a trolley full of groceries. You put that 100 pounds in a box for many years. Eventually, you take it back out. Fantastic! It's still 100 pounds. But you walk into the supermarket. And now, that same trolley of groceries costs 150 pounds. Your money hasn't physically disappeared, but its purchasing power has fallen. It buys less. That's what inflation can do over time. So, one reason people invest is to try to make their money grow faster than the cost of living rises. That doesn't mean investments always beat inflation. They don't. But it helps explain why simply holding cash indefinitely also has consequences. And then, something powerful can happen. Imagine your 1,000 pounds investment grows by 10%. For simplicity, let's ignore fees and taxes. You now have 1,100 pounds. If your investment then grows by another 10%, you're not earning 10% on the original £1,000 anymore. You're earning it on £1,100. You now have £1,210. Then your growth can start earning growth, and that growth can earn more growth. This is called compounding. Imagine rolling a tiny snowball down a hill. At first, hardly anything happens, but as it rolls, it picks up more snow. The snowball becomes larger, and because it's larger, it can collect even more snow. Money can behave in a similar way, and that's why time can be incredibly important when investing. We'll dedicate an entire episode to compounding because it is one of the most powerful concepts in finance. But don't confuse investing with guaranteed wealth. This is where we need to be careful. You've probably seen people online saying things like, "Turn £100 into £10,000. This stock is about to explode. Buy this before everyone else finds out. Become financially free in 12 months." That's not what this series is about. Investing does not mean guaranteed profits. An investment can fall in value. A company can fail. Property prices can fall. Markets can crash. Even investments that have performed brilliantly in the past can perform badly in the future. So perhaps the most useful sentence to remember from this entire video is this: potential return is only one side of an investment. You always need to understand the risk you're taking to pursue that return. Imagine 3 investors. Let's finish with a simple example. 3 people each have £10,000. Investor 1 keeps all £10,000 as cash. Their priority is stability and access to the money. Investor 2 invests across hundreds of different companies through a diversified investment fund. They're prepared to accept that the value will move up and down because they're investing for the longer term. Investor 3 puts the entire £10,000 into one tiny company because somebody on social media says the share price is going to increase tenfold. Technically, all 3 people have made decisions about their money, but they're taking very different levels and types of risk. Understanding that difference is what becoming an investor is really about. It isn't simply learning how to buy something. Anyone can press a buy button. The important skills are understanding what you're buying, why you're buying it, how it could make money, what could make you lose money, and whether that level of risk makes sense for you. So, what is investing? Let's bring everything together. Investing means putting money into an asset today because you hope that asset will produce income, increase in value, or both in the future. Your investment could be a company, a bond, a property, a fund, or another type of asset. But investing always involves uncertainty. There is no magic machine that reliably turns £100 into £1,000. The goal is to make informed decisions about where you put your money and to understand the relationship between risk, return, and time. And over this series, we're going to build that understanding from the ground up. We're going to learn what stocks actually are, how the stock market works, what bonds are, what funds and ETFs are, why prices rise and fall, how professional investors value companies, what diversification really means, and eventually, how you can begin evaluating investments for yourself. But before any of that, there's one idea we need to understand properly. Because every investment has it, every investor has to deal with it. And misunderstanding it can cost you a lot of money. Risk. So, in the next episode, Risk and Reward Explained. Why can investing make you money, and why can it lose you money?